Credit spreads are a fundamental component of fixed income valuation because they represent the additional yield investors demand for bearing risks beyond those associated with default-free government securities. While expected default losses are an important determinant of credit spreads, spreads also compensate investors for uncertainty surrounding those losses, liquidity risk, and risk aversion. Consequently, credit spreads often exceed the level implied by expected losses alone. Changes in economic conditions, investor sentiment, monetary policy, and market liquidity can cause spreads to widen or narrow significantly. Understanding the drivers of credit spreads is essential for evaluating bond valuations, assessing risk, and identifying relative value opportunities in fixed income markets. Several factors influence the level and behavior of credit spreads. The probability of default and expected recovery rates are primary drivers because they directly affect anticipated credit losses. However, spreads also reflect the risk premium investors require for uncertainty regarding future outcomes. During periods of economic stress or financial instability, investors typically become more risk-averse, causing spreads to widen even if expected losses remain unchanged. Liquidity conditions further affect spread levels, as less liquid bonds generally require higher yields to compensate investors. Therefore, credit spreads incorporate both fundamental credit risk and broader market influences affecting investor demand. Analyzing credit spreads involves separating spread components and determining whether market pricing appropriately reflects underlying risks. Analysts compare spreads across issuers, industries, and credit ratings to identify potential mispricing. A spread that appears unusually wide relative to an issuer's fundamentals may indicate an attractive investment opportunity, while an unusually narrow spread may suggest excessive optimism or underestimated risk. Spread analysis also helps investors evaluate the impact of macroeconomic trends, business cycles, and industry developments on credit markets. Because spreads often respond rapidly to new information, they serve as valuable market-based indicators of changing perceptions regarding credit quality and financial stability. Securitized debt refers to securities backed by pools of financial assets such as residential mortgages, commercial mortgages, auto loans, credit card receivables, or other income-producing obligations. Rather than relying solely on the creditworthiness of a single issuer, investors in securitized debt depend on the performance of the underlying asset pool. This structure allows financial institutions to transfer risk, obtain funding, and create investment products with varying risk-return characteristics. Credit analysis of securitized debt therefore differs from traditional corporate bond analysis because the focus shifts from evaluating a company's financial strength to assessing the quality and behavior of the underlying collateral. The credit analysis of securitized debt begins with evaluating the characteristics of the asset pool. Analysts examine factors such as borrower credit quality, loan-to-value ratios, geographic diversification, payment history, collateral quality, and expected default behavior. Cash flow projections are developed to estimate how the pool will perform under various economic scenarios. Structural features, including tranching, credit enhancement mechanisms, reserve accounts, over-collateralization, and subordination provisions, are also critical because they determine how losses are allocated among investors. These protections can significantly improve the credit quality of senior tranches while concentrating risk in subordinate classes. Effective securitized debt analysis requires understanding both collateral performance and structural design. Analysts must evaluate prepayment risk, default risk, recovery assumptions, interest rate sensitivity, and the legal framework governing the securitization. Economic conditions such as housing market trends, unemployment rates, consumer credit quality, and interest rate movements can significantly affect collateral cash flows and security performance. Because securitized products often contain complex structures and multiple layers of risk, thorough due diligence is essential. Credit spread analysis and securitized debt analysis together provide investors with important tools for assessing risk, valuing fixed income securities, and constructing diversified portfolios within modern credit markets.